Welcome to the Ty and Rye the Finance Guys podcast, covering weekly investment news, important financial topics, and expert interviews. We want to help you become more knowledgeable about the financial world around you. This is not an offer to sell you anything, and remember, past performance doesn't indicate future results. Now your hosts, Ty Hansen and Ryan Robertson.
And start talking in one, two, three.
Hello and welcome, everybody. Here we are, Ryan Robertson, Tyler W. Hansen.
Tyler Hansen, ready to roll with Ryan J. Robertson.
The Finance Guys, here we are. Another part to the Peak to Trough miniseries.
Peak to Trough.
Is this sounding like a PBS
top to bottom
special? Here we are.
We should do one of these in an NPR voice.
That's what I'm saying. That's what I'm going for. It's calming.
Are you?
Yeah. So this
Soothing
is part
sounds of finance by Ryan.
I mean, that'll get everybody excited.
Yeah, seriously.
We have done two parts to this. We have done the dot-com bubble. We have done gold. We are now moving into the Mac Daddy, the big cheese. This one really.
This is the big one.
Really takes the cake. We're talking about
Yep.
the financial collapse, 2007 to 2008 into 2009.
Yeah.
This is the one everybody kind of knows and remembers.
This is the Great Recession.
Yeah, it is. And really, like, when you compare numbers, the only thing that compares to it really is the Great Depression.
Yeah,
from
absolutely.
90 years ago. So,
well,
yes, Tycho.
I was gonna say, and a big key point with this one too, as we jump into this, is everything else we've talked about had I think a little bit faster recovery. Well, I mean, it's kind of hard to say with .com, but because some of those things just went completely away. But this thing had a lot longer impact on people than most anything else that we've experienced, in the last 100 years. So, 75 years. So,
yeah,
pretty big deal.
Yeah, and it's going to be one of those things that plenty of people are using for economic models and thinking in terms of portfolio management and analyzing things because of just the scope and the reach that this whole thing went through. So, there's going to be a lot. So, Ty, I want you to promise me, and I want you to promise everybody who is listening. I want you to promise us, right?
Okay.
You need to keep things simple.
I will try. I cannot promise. I can't make a promise I know I'm going to break. So
yes, otherwise you're going to get angry hate mail.
I know. Please tell Ty to stop talking.
No.
You should replace him on your podcast.
Let's bring this up from really .com. You can make a really good connection from .com because we talk about 2002. Really, the .com bubble deflated all the way down to 2002, which moved us into a pretty decent recession, right? In that September 11th time period, and that .com bubble put us in a recession. So what does the Fed do? What's their number one tool in their toolbox?
Yep, their biggest bargaining chip is how they adjust interest rates.
So this kind of starts, we're still in this interest rate period, almost.
Yeah.
Like, I mean, you're talking about from 6.5% in 2000, which is, fairly normal, nothing crazy about 6.5%, down to 1% in 2003.
Right.
So, Ty, tell us, what happens to people when interest rates get down to near zero?
I think we talked about this before. Investors are like water. We always find the path of least resistance, and we're going to find ways to make opportunities. And so when you've got interest rates that low, you're going to start borrowing like crazy, because if I can borrow from you and you're only going to charge me 1%, and I can turn around and I can do something else with it and make 4 or 5, 6%. It's called arbitrage.
Yes.
Right.
Not albatross.
What I think what's
arbitrage.
Yeah, not albatross. That's that giant plane, or the bird.
The bird.
It's arbitrage. The other thing that's interesting about this too is we're kind of coming off, like you said, there was the .com bubble, but there's also like we saw a lot of like Enron, like a lot of like number manipulating and fraudulent stuff happening on earnings reports and things like that. Yeah. So the entire sentiment in the market was kind of like F you stocks. Like people were kind of frustrated with corporate America, right? So yeah, you're right. So all of a sudden rates are dropped. You can get money super cheap. And historically, what do we turn to?
Yeah, real estate.
Real estate. Yeah.
Yeah, well, and we were talking about earlier, too, a couple other pieces to this that might be helpful as you start to think about some of the political agendas going back into Clinton and Bush, wanting to get more home ownership. So you've got Fannie Mae, Freddie Mac getting involved, and just less oversight on the underwriting side of things.
Yeah, and this is so hard. Like, I mean, I've talked to a lot of people about this. Read a lot of information. Yeah, I mean, this is interesting because, I was already kind of in the business as .com was blowing up, but I was really entrenched in the business and starting to really build my own self-employed business. Towards the end of this real estate boom, and as 07, 08 start to hit, right?
Yeah.
So it was really, really part of my more formative years.
Yeah.
And so obviously, having lived in it, done a lot of research, in the moment and after the fact, it's not just one thing, but it was like kind of this perfect storm of a lot of different things. It's political, right? It's greed. It's speculation, right? I mean, because that's the whole point of this series we want to do is the number one theme here is speculation, right? So again, you can't just say, oh, well, it was Clinton or it was Bush or it was the interest rates being too low or it was whatever. It's like, look, it all was fuel on the fire, right? And yeah, you're absolutely right. There was a lot of political influence at this time, and it's like, hey, we want to make every American a homeowner. Let's make that happen, right? So absolutely.
Well, and the funny thing is that both of us, having experience in both financial world as far as money management, investments go, but then we've also had our hand in the mortgage side of it. So
absolutely.
We both sort of understand, and at the time, I, like you, was right in the middle of the whole thing, and it was as it was happening, you could start to really start piecing together, like, oh, we're in trouble here. This is a lot of problems.
Well, the hard thing, and this is why I'm actually like a random side note, but I mean, I wish we didn't have to go through 08, and it was a lot of turmoil for a lot of people, and it was pretty painful.
Yeah.
It was painful for my family. I mean, trying to start a business in that time was like ludicrous. But like it was really good because now looking back, I feel like it's really changed like how I see things. Right? Not that there won't ever be mistakes made again in the markets. I'm not talking about me. I'm just talking generally in the markets. But I'm definitely a lot more critical and hypersensitive to what markets are doing. Right.
Right.
But yeah, at the time it was almost like as we're seeing the equities kind of die off, and more fraud and things like that on the equity side of the market, we're really starting to see real estate ramp back up. Man, everybody had rose-colored goggles on. Everybody did. Do you know what I mean? And
that's the whole problem. That's the whole problem on that ride up. That ride up.
Right.
Nobody wants to stop it. Nobody wants to be the party pooper. Nobody wants to miss out. None of the analysts want to just be like hey, this is no fun. Nobody wants to be that.
Yeah.
And this one is an amazing one because, I mean, what drove it is obviously these low interest rates. Big part of that, right? Now everybody has the ability. Not only do investment banks have more money that they can then borrow, individual investor or just people, anybody can go do it. And you start throwing into it the subprime mortgage market, right? That's not new, but kind of a re-envisioned market where you start to get, and you remember pick-a-pay loans. You can choose fully amortized, interest only, or less than interest as your payment.
Negative amortization, exactly.
Variable rate, 7-to-1 arms, right? Balloon payments.
Yeah.
All of this stuff was working at the time. And you have way more subprime borrowers than ever before. Not because they were subprime. They were just allowing to underwrite more subprime mortgages.
Right. Well, and it's interesting because, so prior to the real, like the height of the subprime time, I had been more involved in with a securities broker dealer. We did 1031 exchanges, and obviously, as real estate values were shooting through the roof, people are selling their real estate. They didn't want to pay the taxes, so they were 1031 exchanging them, right? Mm-hmm. And so, man, we were doing deals like crazy. So even before this kind of was at its peak, I was more involved on the real estate side of the table. As people were exchanging money, right? So they were going from, they owned an investment property in California that they bought for $300,000 that was now worth $1.5 million. They sell that, they take their equity, and they, pool their money with 10 other people, and they buy, a commercial property, right?
Right.
But as I started shifting into the mortgage industry, because again, I had just a ton of, commercial real estate experience, and I loved real estate, right? It was a big part of what I did. I started coming in, and I remember I'd been doing loans. I was doing some loans, and it was like, and to be seriously, I never once did a negative amortization loan, but I remember the first time I heard about this concept, it was like, wait, so you're telling me I can actually take the equity from my house to make my payment? I don't really actually have to pay the bank what I'm technically supposed to be paying the bank. My house will, the equity.
Yeah.
It was crazy. It was so crazy.
Yep. And the whole thing with it is that you start to see this secondary market which comes in.
Yes.
In which it can now all be securitized is really what's happening.
Right.
So because banks are underwriting the loans, but those banks are not holding on to those loans. Right? Those banks are selling those loans. Fannie Mae, Freddie Mac, they're selling them to other investment banking companies who are then packaging these loans together to be sold as an investment, right? This is where this term CDO comes from, or ABS or MBS, however you want to call them. They give them all these different acronyms.
POS.
POS.
Yeah.
POS investments.
So POS investments. Well, and let's take that a step back, because this is so important for people to understand. And if you've ever seen the movie The Big Short, right, this is a lot. This is kind of repetitive to what they talk about in that movie. And but this is really an interesting concept. Is for so long in the banking world, the concept had been, okay, you have if you have $100 million, you can loan. I mean, it used to be back in the day, it was you can only loan the $100 million, right? And not all of that's going to go to real estate, right? And then they're like, well, you can leverage yourself 2 or 3 to 1, right? So you're talking, okay, well, now we can do $300 million, right? Which is great. That means you can do more business. There's more loans to go around. You can offer houses to more people. Yeah. You don't have to have 20% down anymore. Well, now it's wait a second. So, because I don't know if people understand this, but inside of your mortgage, even though you're technically writing a check to Wells Fargo or Chase, they may not actually own your note, right? They're not the actual person whose money that you've borrowed, right? There's the note. Exactly. There's note and there's servicing, right? And those get broken apart. So to your exact point with these CDOs, right? These collateralized debt obligations, fancy word for saying the note, right? Or the debt part.
Yeah.
They carve out all these debt pieces from all these mortgages, package them up. So this now lets banks kind of get again, political banking greed. It's seriously, it's not just one group. It's not just lenders. It's not just real estate agents. It's not just investors. It's not just Wall Street. It's not just politicians. It's everybody. Everybody was greedy as hell, right? We've come through this dot-com bubble. Well, let's make a crap ton of money in real estate. Let's speculate the hell out of real estate, right? Yeah. So we start packaging, and now banks are like, sweet. Well, rather than me just doing $100 million worth of loans, I can do $1.5 billion of loans.
Oh, yeah.
We're going to make a lot of money if we do this.
Well, and it's just one of those things. So the bank can underwrite the loan, right? They start it, and then they sell it. Well, what does the bank get? They get back the money they just lent. So now they get that money again, they can redo that loan. So the more that you can sell those loans off to a secondary market, which now there is a big demand for this, because people are thinking, and obviously any of the investment banks that are putting these together, and then the investors that they're selling them to are thinking, oh, well, they're asset-backed loans. So that means there's a property that's backing up the loan. And they're homeowners, which means they're more than likely to pay the loan because that's where they live. So people started to think that they were safe.
Yeah, these are awesome. Yeah. So and think about this too. Let's go back. You're the history buff, so go back. Yeah. 5 years? 4 or 5 years earlier, before this is really ramping up, because this concept wasn't new. I mean, some of the CDOs and these synthesized, these like packaged products from Goldman Sachs, some of the bigger investment banking companies, they were a little bit newer, but this concept of like deleveraging the books, right, so that banks can now offer more. This had been around since the 80s and 90s. Like it was something that was there, right? But now we're talking like, again,
supersizing
like we talk, like with crypto, like with cryptos, right? Like cryptos have been around for a while, but all of a sudden like there's some catalyst to it that all of a sudden makes it really attractive, right? Yeah. So now these are starting to go out, and you're absolutely right. So remember, 5 years prior to this really being super huge and crazy, you've got like, what were some of the companies we talked about that went under with the dot-com bubble? Pets.com. What were some of the other ones?
Pets.com, Flooz.com, Webvan.
Flooz, Webvan. Like, I mean, crazy things that just like, and then Enron, crap like that going on, where people are like, we don't know anything about these companies. Yeah. We're the lowest person. Think about this, because there's when somebody goes bankrupt or they're losing money, there's a hierarchy legally. There's a hierarchy of who gets paid first, right? And if you are a collateralized debt, right, meaning there's actually tangible something there that is what the debt's made on, right? That is way higher up the pecking order, right, than unsecured debt. It's secured loan, right? So you're really, really, really high up there compared to common stock, right? And so people are like, why would I want to be common stock if I can be investing in this real estate piece up here that has something? And you're absolutely, you hit the nail on the head. When do homeowners not make their payments? Yeah. For 50 years, since 60, 70 years these products have been around, people have paid their mortgage payments, right? What's that family in what's the name of the family in It's a Wonderful Life, where they make the loan to the Italian family?
Oh, like,
it's
Martini.
Here's the bread, here's the wine. The Martini family, right? Mm-hmm. You know the Martini family is going to make their payment, right? Yeah. Bailey's building the loan,
Bailey,
right?
He knows
and that's exactly. He knows. Yes, this is what we're used to. So yeah, no Americans are going to stop making their payments. So why not sell a crap ton of this stuff? Because it's the American dream. Yep. The presidents have even said, "Hey, let's give everybody this American dream."
Yep. And then you sprinkle into that, right, subprime borrowers, which riskier borrowers. Obviously, they have lower credit. They have a history of not paying debts.
You have a face. You get a loan. Are you breathing, Ryan? Are you breathing?
Stated income loans, right? You just tell them what you make, and they trust it. Yeah. Right. That was happening.
Oh, yeah.
So now they start to package these things together, right? We've heard the whole the adage, right? One rotten apple ruins the whole bushel. Is that how it goes?
Yeah. I think so, something like that.
I've
never owned an orchard, so I don't really know.
One bad egg
ruins
the whole.
Turns the chicken sour.
Something like that.
No, not chicken. No. Okay. Yeah.
Right. But the basis of a lot of the subprime mortgages were all based on the idea that property values were just going to, at the very minimum, have a basic level of growth to them, and that just can't happen. It's impossible because at some point you're going to hit this peak where property values cannot go up anymore, because even those subprime borrowers and the mortgages that are built on them can't. And then the other thing you have that gets thrown into that is the increase in interest rates, which they artificially made them low for the dot-com burst bubble. And then as things started to really stabilize, market starts getting better, they're like, well, we got to raise rates because things are going to get out of control, inflation and all of that. So all the the variable rate mortgages, those 7-to-1 ARMs, the ones that a lot of subprime borrowers were getting, it changed, and payments, some of them doubled, tripled. And
even some of them were some of them were 1-year ARM, 2-year ARM, like 3-year, so crazy, so crazy. Yeah.
Yes.
Oh yeah. Well, and think about this. So not only do the interest rates have an impact, but it's like, so you've got all these people through the subprime offerings thinking, oh, I need a house. I want a house. I can get a house. Well, guess what? We start running out of houses, right? Yeah. And it's like, well, crap. Let's build them. Let's build like crazy, right? So yeah, you've got you've got people that are demand that's just through the roof, right? And a lot of it's artificially created by the subprime, garbage. Yeah.
So a couple of things that I think that maybe just can be kind of help understand some of the real the bubble that gets created here. So the biggest one is that allows for it is going to be this leveraging point for banks. Mm-hmm. It moves from, like you were saying, this maybe 4-to-1. They can lend out $4 for every dollar that they've got on the books. I mean, we're talking about leveraging rates upwards of 30 and 40%, or 30 to 40 times.
So there were even European banks that were leveraged 3,000 to 1. 3,000 to 1.
Unreal.
Bonkers. So crazy.
I was telling you right before we started this this company, Bear Stearns, right? They were one of the big players in this that ended up just going bankrupt because they had leveraged to a point that just a swing in home values of 3 to 5% would wipe out their
decline of 3 to 5%.
Decline of 3 to 5% would wipe out their entire fund that was used to buy these CDOs. Just a 3 to 5% swing. And it's because of that leveraging. So it amplifies. When you leverage that much, it amplifies those movements.
Well, and not only that, what was interesting too, and I was telling you about this as well. So when I did my master's program, part of the reason I chose my master's was because there were a couple of professors there that had some really cool experience in these fields, right? Yeah. And so one of my professors actually had been, I think it was Citi. I think he worked with Citi back on Wall Street, and he was one of their big arbitrage traders, right? With these CDOs, like he helped them make a ton of money, and he actually ended up kind of getting out of the game, about 2004, 2005. So he kind of got lucky.
Perfect.
Anyways, so he was part of the problem, and he totally admitted he's like, oh yeah, I'm part of the problem. Yeah. But it was cool. So we actually broke apart these. They're called, there's different tranches or levels or layers, right? We would break them apart to see where, like how much is this going to make? How can these be bought and sold? Like what are the actual mortgages that are making up these bundles, right? So it's pretty interesting. And so not only housing prices too, but if you had interest rates rise so much, we basically would test these buckets, these different tranches to see, okay, if rates go up so much, or like you're saying with housing prices too. So from both fronts, what does that really take? What's the stress test on this thing to see if this whole barrel goes bad, right? One last thought too with this. So I remember reading an article end of 2008, early 2009, and they talked about, because they were dissecting, okay, what went wrong. So not only that, but as you've got these large so who's buying these mortgage-backed securities, right? Because if they're packaging up billions of dollars of this, who's buying it, right? It's hedge funds, it's institutional investors, it's pension plans, right? So like
big ones.
The state of California pension, right? Like hundreds of millions, if not billions of dollars. They have these large money managers that say, okay, well, real estate's super, and mortgages are super, like we talked about, low risk. And so whenever people buy these investments, the SEC makes these companies put out what's called a prospectus, right? So you know what you're getting into. Well, they would call these, like, they rank funds,
Yeah.
right? There were grade A, like there's A, triple A, B, double B. I mean, there's different ratings, right? And depending on the garbage is, so you should get a higher return if you've got more garbage in there, whatever. So they would literally, they would call them, grade A bond funds, right? And so those historically were better type, funds for these pensions to buy into.
Right. Yeah. Yeah.
Well, they did a small tweak to the verbiage in that prospectus, and they called it a grade A type of bond fund.
Good. It's a great way to.
So
put
they
it.
literally added the word type.
Yeah.
It's kind of like it.
It's not grade
A little
A,
bit of shit in here.
It's like grade A.
It's not. It's a type.
It's
of
a
grade
type
A,
of it,
right? Yeah. It's like, anyway. So that's what I'm saying. So as these are being packaged up and people are buying them, that's kind of the stuff that's going on behind the scenes. So people are like, oh yeah, we're buying great stuff here. This is awesome.
Yeah.
Right.
So and the rating agencies, there was a big scandal with that too.
Yeah.
Nobody that was putting these together and who were really in the know were pricing in the risk involved with it very well. And that ranges from just kind of naivety to actual, like, we're trying to pass this off as grade A and it's not. There's varying
exactly.
levels within that for how they were doing it.
Well, and again, to kind of keep the whole point of this mini-series is to understand speculation, right? If we don't learn from the past, we're bound to repeat it again, right? And so that was
on a previous podcast, Ty.
That was. So this is this idea that we're talking about is, again, I hate when people try to pinpoint the Great Recession to one group or the other. It's like, listen, everybody was so damn greedy. Everybody. Now, don't get me wrong. There were definitely investors who were a lot more passive, and they definitely got burned, right? Mm-hmm. The common man and woman definitely took the brunt of this.
Right.
I'm not discounting that.
Sure.
But at every level, from the common man, woman investor all the way up to Wall Street, it was nothing but greed. All the way through. Yeah. Right? Yeah. And that comes back to this point you're saying. I think it was, we want to really scrutinize these deals, but we're also turning a blind eye because, hey, we're going to make, on this super low risk investment, I'm making 6, 7, 8%. Awesome. Let's do it. Let's rock and roll. Yeah. You know what I mean?
So as they, started packaging all these loans together, it was based upon the idea that A, everybody would continue to make their payments, and B, more importantly, real estate values would have some consistency to them. Didn't even really need to rise that much. It just needed to sort of stay on a steady path forward, and everything would work fine. Defaults would happen, but they'd happen within a certain normal range. Yeah. And that would be fine for
those
the
ranges
whole
I talked about. Yeah.
Yep.
Yeah.
But what obviously happened is you see interest rates rise, and you start to see all of the subprime loans basically go into default. And one of the big issues at the time is that nobody really had much of an opportunity to rework their loan. And it is because the servicer had no power to reorganize your loan for you. It was owned by a hedge fund, that there was no centralized authority to make the decision like, hey, you can't make your payments? Okay, let's rework your loan for it to work.
Right.
Everything in that situation wasn't going to happen, and the only thing that could work is you make your payments, stay on top of it, or you're in default and you're going to have to foreclose on the property.
Well, and that's the thing that was so crazy about this is, like, overnight, all of a sudden you start to see the, like you talked about Bear Stearns, Lehman Brothers, you start to see these bigger institutions crumble because they bet just as much on these as anybody else did, right? Because, I mean, man, if it was like the most attractive thing to these investors because it's like, and banks, because it's like, dude, we've got something that will never fail, and we're going to make, double-digit returns. Like, this is a no-brainer, right? We got to do this. So as those start to crumble and you start to see all this garbage, like, oh crap, there's a lot of garbage in here, right? You're right. It's like, I mean, people would go. People went 2, 3, 4 years in default without being evicted from their home.
I knew people that had done that.
And you're right. And it's this idea that it's not that, okay, I've borrowed $100,000 from Ryan so I can buy my house, and so I'm going to talk to Ryan. We're going to work this out, right? It's not that,
right?
Or Ryan's just going to take the house back, turn around and sell it, make money on it, right? It's not that. It's Ryan owns 1/100th of my mortgage.
Yeah.
John Doe over here owns 1/100th of my mortgage. Jane Smith down the road owns 1/100th. And it's actually even more complicated than that.
It is.
Right?
Yeah.
As you start to break down these tranches. And so it's like, anyways, yeah, I mean, you think about what utter chaos was created from these CDOs and the whole housing crisis of 2008. I mean, it went so deep. It is insane, right? And again, boils back to speculation and greed. I just want a big return and FOMO, right?
Wow.
If I'm 64 years old and I've got a CD over here that may pay 2%. Well, what about this like real estate fund that I've heard about, or you can put my money into this. It's going to make me 8 to 10%, or maybe I'll buy Fannie Mae or Freddie Mac stock and add that in my portfolio. It's like people got way too greedy with their portfolios.
Yeah.
You know what I mean? And we have something that starts to take down an entire substructure of our entire economy.
Yeah.
The real estate and housing market.
And if you relate this to all of the other sort of speculation that we've talked about, really what happens is there's no real sure foundation for what the value is. Nobody knows what the value is. Right. When we talk about .com, we didn't know what the value was. We were speculating the value was going to be really high. We talked about gold. We don't know what the value is. We talk about cryptos. We don't know what the value is. And in this case, building it on real estate and these CDOs that are built on that, we didn't know what the value was. Nobody knew really what that value was because it had been overinflated so far. And you just have these a couple little ticks that start happening. Interest rates go up. Real estate values start to decline a little bit. And you start seeing people default. And now it's just one chain in that link going dominoes. Just start to
the
fall.
whole thing. Yep.
And now you've got this problem where nobody can actually, the free market cannot come in and solve the problem.
Right.
Now, this is not a discussion about government involvement or anything like that. But what the problem is that there was no mechanism to stop it because it was interlinked to so many then different companies that none of them had a good answer for it. And, that when that starts happening, it just creates now this, as you think about just the chaos of the whole time.
Yeah.
Default after default after default. Bankruptcies.
Yeah.
Companies going under. Homes being left. Abandoned. Buildings. Everything just started to crumble, and there was just no real way to get back to a baseline that everybody could okay, we've hit bottom now. Nobody knew. I mean, I lived in St. George back then, St. George, Utah, and from peak to trough on home values was about 55% from 2006, roughly the peak, to 2011. 2012, it's about 50%.
Yeah.
So, nobody knew where that bottom was.
Right. Well, and even heck, I mean, some of Arizona, Florida, some of those markets, I mean,
Vegas
they lost
was a big one.
70, 80%. Yeah, Vegas. I mean, it was crazy. And at the same time, because this real estate market there were so many, fingers from these CDOs that went out, again, these different hedge funds, financial institutions betting on these same things, pension accounts, the entire infrastructure of the real estate market crumbled. The wave was so big. I mean, the market from peak to valley, 2008, 2009 was down 57%.
Yeah.
Right. That's just it's just mind-boggling how powerful that was. And again, we talked about this before, but what's so powerful about this speculation, this definitely has a little bit more of a long-term feel to it versus .com and cryptos and things like that. But still, it's it was kind of quietly ramping up, and there was so much fuel being put into it. I mean, this took about 4 years for the market to fully recover from this trough.
Yeah.
Right. That when it bottomed out.
Let's go through those numbers real quick because it's always interesting to see them, and then let's talk a little bit about some of the lessons because I do think this one is different from what we're talking about with .com and what we're talking about with gold because .com and gold is something that you're choosing to get in and kind of really getting caught up into it. And yet, yeah, a lot of us might have get caught up in the real estate market then, but a lot of us were just doing normal things too.
Yeah.
Oh, you just get a loan.
Good point.
They are giving me a loan. I'm just buying a house. Yeah, maybe it's a little overvalued, but whatever. And, there's a little bit, but this is where it's important to understand with these lessons that you really can have a keener sense of like, something's off here. Something's wrong here, even though it's kind of affecting everybody. Anyway, we'll come back to that. Let's talk about these numbers real quick, because they're insane. So this is, and I'm given the year 2000, just because there's a decade plus of almost no movement in the market, which is depression era type stuff.
Right.
So
exactly.
in January 1, 2000, S&P 1394. Okay, peaks 2000, the S&P at 1517, right? Then you get the then you get the .com, it goes down 47% to 800. From there, builds back up again, almost doubling, going up 95% to 2007 at 1561. And that is really then where you start to see the big companies like Bear Stearns start to falter. Everybody now starts to go, oh, this is bad. And this continues on for the next year that they're trying to figure it out, and people are basically trying to come up with solutions outside of the government bailing everybody out. Right. There was a lot of stuff happening. And you remember that time. Right. I mean, we're seeing days of the market moving 1,000 points. Well, that was on the Dow Jones more, but still. I mean, we're seeing days that were just out of control. And they had to turn off short selling. They had to stop the market. They had to just close it for a day. That happened a lot in 2008. I mean, I can't imagine what that would do now with social media and everybody's connected. I can't imagine how that would feel now.
Exactly. And that's the whole point of this too is I mean, and obviously that's a longer period of time or that year, but there were definitely periods along that way where you're right. You'd see days that were so powerful. And I mean, unfortunately, like I said, not all investors were super greedy, but they were
making decisions that they needed to
high single percentages into the double digits in their long-term pension accounts.
Yeah.
You know what I mean? Again, which I don't put that on the common investor, right? Because a lot of this was done at a higher institutional level, but still, it's like, man, something's out of whack here, right? Way out of whack. And so people not diversifying away from that, right? All of a sudden your retirement that you're planning on living, your $2, $3, $4, $5 million, $10 million, depending on how you manage that in that time period, I mean, you're seeing 30, 20, 30, 40% gone like that.
Yeah.
Like it's crazy. Yeah. So crazy.
So the market peaks October 2007, that 1561 on with the S&P.
Yeah.
And then from there to March of 2009, drops 56.25%. Probably some intraday drops that were 57, 58%. But it ends that day in March, 56% down.
Yeah.
And this, I kind of put this in there because I wanted to see. It took then all the way to March of 2013 to get back to what had been lost right before in 2007. 1,995 days between those
4 years.
4 years. 4 years.
And 4 years to recover.
But look at that number in 2000. January 1st, 2013, 94. Look at it in August, 1517. So you talk about it, 13 years. Crazy, it didn't move hardly at all. It was maybe positive if you stayed in that whole time. That's a long time. That they call it the lost decade for a reason. There was just nothing.
Yeah. No, that's a good point. I didn't think about that. The lost decade point. Yeah. It's crazy.
Because your money didn't go anywhere. So, Ty, give us some lessons from this. What are we learning from this? Give us some wisdom.
I mean, again,
you're the historian here. What should someone do?
How often in history does history repeat itself?
Well, it's funny because the real estate and stock market has this almost 7-10 year cycle to it. Has for a long time of like up to a real sustained downturns like in that time period.
Exactly. And there's always this kind of like greed catalyst, right? So we're sitting in this 13 to 2021.
Long time.
How long has that been?
Yeah,
it's been about
8 years,
7 8 years. And granted, we had COVID last year, which was interesting. COVID peak to valley was about down 35%.
But
that recovered in like 2 or 3 months.
Yeah.
It was crazy.
Nothing.
But so anyways, the point is this. Are we going to correct this year, next year? Nobody knows. So the lesson to learn here is there's always going to be some shiny new thing, right? I mean, I remember we talk about the banner ads from 2000, right? We talk about like everybody and their dog wanting to buy gold at different periods when it was super, super hot and speculative. We're talking about like seeing ads now on social media, on Instagram and Twitter for cryptos, right? Yep. The point is this, like, and the same thing happened with real estate. I remember driving up and down the freeway here in Utah, right, in Salt Lake County, in Utah County, right, and seeing these billboards for like free capitalists, right?
I remember that.
Yeah, the free like make all this. In fact, the funny thing is that guy ended up in prison for fraud.
Yes, he did.
But here's the point: is it's like there are ways. There always has been, and there always will be ways. Now, granted, for the most part, a large share of the market in 08 and 09 got its butt kicked. But again, there were still ways to be diversified away from that, and there are ways now. Yeah. And so the point is when we see these new shiny objects, these new end-all, be-all investment strategies, it's like, should you be taking a huge chunk of your money and getting into those? No. As you get older, right, and you're coming into your retirement years, mid to late 50s. Because think about that. That was, what do we say, 4 years, right? So if you had $5 million saved up, right? Actually, that's a little bit above average. Let's say that you had $1 million saved up, right? In back then dollars, which today that's probably more like $1.5 million, $2 million. So if you had $1 million, back in 07, right? You lose half of it. You're down to 500,000. And you're 55. You're okay. I mean, you can recover from that, right? You can get back into it. You're now in your mid 60s, right? You're okay. You can retire. You got your $1.5 million, $2 million. You've made even more since then. You're okay. If you're at 60, 61, 62, 63, 64, you can't. That's a little tough to recover from.
Yeah.
Right? Because you're kind of now. So my point is this: it's like when FOMO is there. When the markets are very greedy, when we've got some random new thing that just is more speculation and less true substance to it, it's like, why would we ever chase these things, right? Yeah. Why not have a better plan in place? Why not be better diversified? Why not have a piece that's going to guarantee me certain returns? You know what I mean? That's a good one. That's the lesson to learn. Yeah, that's the lesson to learn.
It is a lesson to learn, and when we think about the idea of the market kind of having this general upward trend over time, it does. But you've got to take into account that what if that happens when you're 68? What if that 08 happens, you're 68 in 2008? Yep. You have to be able to prepare for that type of a risk. And there's things you can do. You just I have to do it.
Go ahead.
Stop chasing the shiny stuff.
Yeah. And stop FOMO. Stop the FOMO.
Stop FOMOing.
We need to make
stop
T-shirts
the FOMO.
To give to clients that says "Stop the FOMO."
Hashtag
I love
stop
it.
the FOMO. That's a good one.
You know what? There were some fixed annuities. Now, not that this whole segment's about us selling an annuity. It's not. But there are clients that went through 08 that had 30-40% of their portfolios in something that was guaranteeing a 5 and 6% return, 7% return.
No.
How much better off are you if your portfolio, 50% of your portfolio returns you 7%, 6%, and the market's down 50?
I know.
Like, you know what I mean? Like, it's bonkers. Yeah. So there are many other tools. And not only that too, you know what I mean? Even I had clients who owned real estate and they were well diversified. In fact, I've got a ton of clients that held on to their real estate through that bubble pop. And still, in fact, even my dad, he wanted to dump one of the properties that we had seriously, my dad wanted to dump the property because it was upside down. And he was so frustrated. And I was like, Dad, relax. Let's hold on to this thing for a couple more years. We've got tenants. We can work through this. And sure enough, 3 years later, he ended up selling that and put about $75,000 in his pocket. You know what I mean? But if all your money is there and you're not diversified, you're screwed. You can't do that.
Yeah.
Right? You've got to fire sell. But if you're diversified and you can weather some of these storms, in fact, some of the wealthiest clients that I've worked with, not to make them sound like vultures, but man, there were some awesome real estate deals to be had, and you could pencil a deal that looked really sexy in 2010, 2011, 2012.
Yeah.
Right? You were picking up real estate for 30, 40, 50 cents on the dollar, and it was awesome. Yeah. But you had to have weathered the storm the few years before.
Yeah.
So,
yep.
Be the vulture. Fear the FOMO.
Sure. Just think about it in terms of how do you actually prepare for something like that. And I know it seems daunting. You're like, how do you prepare for a 55% drop in the market? Well, yeah, that's kind of an anomaly, but there definitely are ways to do it.
Yep.
And
absolutely.
You just got to sit down and really think through that process. Anyway, great lesson.
Good times.
Great lesson.
Very good.
I think we basically we've hammered this down, hammered it home.
We're good.
And I don't think there's anything else we need to bring up.
No, I think we're good. I think we're really good. Fear the FOMO.
Anybody that's listening, you can follow us on tieandrye.com. You can also follow us on your favorite podcast platform. Or go to myprosperteam.com. You'll see us on there. And follow us. We'll have another Market Mini come out next week. We'll have another one come out
awesome
a week after that. Ty, thanks for your time, buddy.
I appreciate it as always, my friend. Good time.
We'll see everybody next week.
Have a lovely week.
Thanks.
All right, thanks, bud.
Bye. Hey, thanks for listening to the Ty and Rye, the Finance Guys podcast today. If you like what you heard, go ahead and hit subscribe. That way you won't miss any future episodes. Also, follow us on Instagram, Twitter, Facebook, Ty and Rye Podcast. Also, check us out at myprosperteam.com. Thanks. We will see you next week.